Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day to spend it with us. We're in an interesting time for the markets right now, the last few weeks of August. A lot of individuals trying to spend those last moments at their cottages or summer homes. A lot of traders on Bay Street and Wall Street really just soaking in the last few days of summer, hopefully the last few nice days weather-wise of summer. So we tend to see lower volumes of trading on both the Toronto Stock Exchange, the New York exchanges, the NASDAQ, whether the indices tend to be a lot more volatile at times because of the trading volume. So an interesting time of the year. Today's show will be also interesting, in my opinion, because it'll probably be the first show in quite a while where we're not emphasizing tariffs and trade as much. And we try to bring up some new ideas and talk about some new things. Now, yes, a lot of the things we're going to talk about today, as always, are answering the questions that individual investors have, but we're going to try and stay away maybe a little bit from the tariff talk for the time being, even though tariff and trade continues to influence what individual investors do on a regular basis and continue to make the headlines in the media. So let's put up what we have on our show for today. Doug Ford meets with PM Carney, Prime Minister Carney, regarding tax cuts and trade special projects. This past Monday, Premier Ford met with the Prime Minister, and on his agenda, as he mentioned to all of us, was to discuss the possibility of cutting taxes. And Premier Ford and I have spoken a couple of times over the last month or so, and I talked about the need to cut taxes, and the Premier was very much in agreement with that. And I made the case why the Bank of Canada should also be considering cutting interest rates. And I think the Premier agrees with that as well. So Premier went to Ottawa, talked to the Prime Minister. We're going to talk a bit about possible cut in interest rates, cut in taxes, how important it is. So we're going to talk about that off the top of our show. Our next segment, as always, talks about the top 3 things that individual investors should be focused on before they make their investment decisions. Very popular part of our show. As always, we'll have 3 ideas. How long can markets keep climbing? Well, if the last day and a half is any indication, perhaps the markets are no longer climbing, at least for the moment. We've seen markets sell off yesterday and the continuation of the sell-off today, especially in tech land. Why is that? Well, a great question, and we're going to try and discuss it. Snapshots of the markets in 2025. These are interesting data, statistics, interesting pieces of information that we wanted to bring forward to all of you watching today. Some things might surprise you, some things probably won't, but interesting stats on where things sit. You know, best stock performer in the S&P 500, best index that is across the world today, what's the best performing market, etc. Those kinds of things. Are markets and investors ignoring inflation and worrying too much about jobs? And this is primarily in the United States. We hear a lot lately about how the Fed should be cutting interest rates. I guess it seems as though inflation is not as big of an issue to many as is a slowdown in job creation, which is the mandate of the Federal Reserve. They have a dual mandate, as we've said many times, job creation and stable pricing. Well, pricing has become a little bit unstable, yet everyone seems to be focusing more so on jobs. So we'll delve into that. Quick hits. 3 ideas that you may have seen in the news over the past few weeks that I will comment on. And last but not least, your questions. If you have any questions during the course of the show, please put them in the chat boxes. I would love to answer your questions at the end of the show, or as we do quite often, answer any questions on our next show or throughout the 2 weeks until or leading up to our next show. So without further ado, let's move on with our show. So Premier Doug Ford went to Ottawa on Monday morning. He met with Prime Minister Carney, and when he came out of the meeting, everybody seemed to be quite happy, cordial. I know the Premier said they had a great conversation. I know the Prime Minister was very much, it looked like he was quite happy with the conversation. Not so sure what was accomplished. I haven't really heard much, or we haven't really heard much from the Premier since. I know, and we all know, because the Premier made it very known that his idea, or why he was going to Ottawa on Monday, was to have a conversation about stimulating the Ontario and Canadian economy. And how would we do this? By cutting taxes and hopefully, if obviously not in the jurisdiction of the Prime Minister or the Premier, but hopefully getting the Prime Minister on board, perhaps to talk with or to speak to the Bank of Canada about a cut in interest rates. Both of those things, in my opinion, are so important. If we are all hands on deck to fight this trade war with the US, to try and stimulate our economy, which seems to be pretty flat right now, we haven't dipped into negative territory. So we haven't heard the word recession as yet, but we're pretty much flatlining around the zero mark, or break even, if you will. So we're not growing, we're not in decline or recession. We're just kind of moving sideways. And that really isn't good enough. And we're hearing more and more about jobs being, unfortunately, lost by a number of individuals in different sectors, whether it's the steel industry, the automobile industry, copper, any of the base metals, mining in general, or whether it's just simply in small businesses throughout Ontario and the country as a whole. We're seeing jobs decline, and we saw our last jobs report talk to us or showed us that we're seeing a country that is definitely not in growth mode. So in talking to the Premier, I expressed my concern. The Premier agreed. And he's trying to do something about it. He's trying to get the Prime Minister to cut taxes or consider cutting taxes. We are one of the highest jurisdictions for taxes in North America. Interest rates, yes, they have come down quite a bit in the last few years, but with an inflation rate under what the Bank of Canada would like to see, which is a 2% rate. We came in at 1.7 most recently. Why aren't we cutting interest rates as well? Why aren't we trying to do whatever it takes to stimulate our economy? And this is the question I believe that Premier Doug Ford spoke to Prime Minister Carney about. As I said, not sure what the outcome is or will be. I believe we may see a budget being tabled in the fall, so perhaps we will get some more information in the coming weeks about maybe a tax cut of substance. I know we did get a tax cut of 1% when Prime Minister Carney was elected, but that truly isn't enough. It puts maybe a savings of $300 in the pockets of Canadians, which may buy you dinner one night. But truly, we need a meaningful tax cut. We need to bring down taxes to compete with the US. We're doing great things on deregulation. We're trying to forge trade relationships around the globe, but we need to be more competitive. And how are you going to be more competitive? Cut taxes and cut interest rates. Cut personal tax, cut corporate tax. We need to be as competitive as we ever going to be able to compete with our neighbors to the south, because that's what they're doing. And as this trade war lingers on, we know next year USMCA will be up for negotiation in 2026, and I believe you're going to see some changes. I'm sure the President Trump, will be making changes to that agreement, and who knows where that will leave us. So I think we need to make changes to make our country a better place to do business. We need to do it now. We don't want to wait until 2026 when the rules change, the trade deal changes with the US and Mexico. We want to do that now. And so I think a great time and a great call by the Premier to go to Ottawa to speak about these kinds of things. Our first chart here that we have in this segment actually talks about inflation. You see here our inflation rate, 1.7%, Bank of Canada rate, 2.75%. Again, a bigger gap now. Target for inflation is 2%. I think there's a lot of room there. You have a full percentage point between the Bank of Canada rate and the actual inflation rate to cut interest rates. One, maybe two times before the end of the year. Let's bring down interest rates. Let's start to stimulate this economy. start to stimulate the housing market. We're hearing a slowdown, new builds, these things, the housing industry slowing. Just go around and talk to some of the people that are trying to sell their homes now. In a lot of areas in the GTA, Greater Toronto Area, you're finding people having to lower the prices to sell their homes in certain places. So let's try and bring down interest rates. And I think that's a fantastic idea. Our next chart shows where we sit as a country with respect to international tax competitiveness. And if you look here, you can see the red circles show us. You can see Canada is 26th in corporate tax, 31st in individual taxes. Compare that to the US, 20th in corporate tax, and 17th in individual taxes. So how are we going to compete if we are charging 50% tax as our highest tax bracket, 54% for some individuals? I understand we are constantly concerned about people in the lower brackets. People aren't fortunate enough to make as much, and I agree. So let's make a tax cut right across the board. All brackets. Let's bring them down something meaningful, 10%, 15% perhaps. Let's become this place, this country where everybody wants to do business in and with. And in my opinion, I think the only way to do that is to make it a great place to work. Keep money in the hands of individuals, in the hands of the businesses. And if you do that, as the Premier says, people will spend money. They'll go shopping. They'll buy flat screen TVs. They will try to grow their businesses. But if you make it very difficult, if we as a government here in this country continue to make it difficult for businesses to grow because they can't borrow money at low rates, because everything they make is taxed at such a high level that they don't have as much money left over to do the things they want to do, then how do we expect to grow our country at a time when we really need the growth? And so very, very important. As you can tell, I'm very passionate about this topic. We need to cut taxes, and we need to cut them meaningfully, and we need to follow that with a cut in interest rates. And then, and only then, in my opinion, will we be able to be a lot more competitive with our neighbors to the south and competitive on a global scale. Now, the part of our show that seems to garner a lot of attention from individual investors is the part where I talk about three things that I think individual investors need to focus on before you make your investment decisions. And as I said off the top of the show, there's nothing there that says tariffs or trade. So definitely different topics this show, and we try to bring you some new ideas. The first one, the Fed chair speaking at Jackson Hole this Friday. And as you may recall from other shows we've done in previous summers, we talk about the conference that the Federal Reserve puts on in Jackson Hole, Wyoming, where they make announcements, they talk about policy. And at the end of the conference, Jerome Powell, the head of the Fed, chairman of the Fed, will have a speech, and we all will listen to his speech, parse through every word, every pause in his speech. We'll probably chop it up a million different ways to figure out what is going to come of their next interest rate decision, I believe on September the 17th. And a lot of pressure on the Fed right now to cut rates maybe once or maybe even a couple of times for the remainder of this year. So we're going to talk about the Fed and Jackson Hole. Corporate earnings. Yes, we've pretty much done or gone through all corporate earnings except for just a few. And what are those few? Well, the biggest company in the world today, NVIDIA. NVIDIA will report earnings, I believe, next week. I think it's the 27th that they will report. Largest company in the world. What they say, how they say it, and what they say going forward. Their look ahead for future business will definitely move the tech sector, the chips market or sector, and the markets in general. And definitely not to leave behind in any way are banks. Canadian banks will report earnings next week as well, and definitely a market mover for many Canadians who own a lot of bank stocks. And third point, buying good value wins out in all markets. And I'll explain what I mean by that A lot of people saying, Allan, if you think that there's going to be some choppy markets ahead over the next 4 to 6 weeks, would you still be buying into this market? And my answer is, if you own good value at a good price, your investments will rise over time through any type of market. So let's go to our first topic, Fed Chair at Jackson Hole. And I guess we can talk about what's been going on. As many of you know, a lot of pressure being put on by the Trump administration with respect to wanting the Federal Reserve to cut interest rates. I know that President has said many times, if the Fed were to cut rates, then the interest on the U.S. debt would, in essence, be obviously a lot less. And that's not, unfortunately for the president, not what the Fed is supposed to be doing. If you want to have less interest payments on your debt, then my advice would be to have less debt as a country for the United States. So there's a lot of pressure going on. There's a lot of, and we talked about this last show, a lot of now a few Fed officials actually breaking away from the consensus at the Fed, saying they should be cutting interest rates, perhaps not for the same reasons as the President Trump wants, but because things are starting to slow down. Our first chart here is the target range for the Fed funds rate. You'll see here 4.25% to 4.5%. It's come down a little bit, but definitely not as low as it's been over the last, well, let's say over the last 5-10 years. We are at high points, and many believe, many economists, many people that are vying for the next or to be the next Fed chairman are saying that the interest rates are what they would say or call in restrictive mode. And I guess with people now putting a lot of pressure, with the jobs growth starting to slow, economy's slowing a little bit in the US, still not bad, but definitely slowing. I think a lot of people, a lot of investors are betting that the Fed is going to cut rates. And they're betting pretty hard. So much so that, as our next chart will show, they're betting that there's about an 85% chance that the Fed's going to cut rates in September by at least a quarter point. And we could show that chart up right now, 84.8%. The CME Group Fed Watch tool, there it is. You can see on the left-hand side, it's tough to make out the number, but you can see how large of a bar that is. It's 84.8% chance of cut, and only a 15% chance that they're going to leave things as they are. So it is interesting that everyone is on one side of the boat, so to speak. And at times, when you see those kinds of things where everybody's betting on something to happen, if it doesn't happen, well, what would that mean for the stock market? I would say it could be a big negative for the market. So if Chairman Powell, if the Federal Reserve in general does not cut rates in September, that might mean a bit of a pullback for the markets, which would coincide with the time of year that we're at. Usually September is a bit of a volatile month, one of the negative months for the year, as we'll see in a little bit later on in the show. Our next chart shows that there actually have been pretty big bets, open interest builds in the options market for as much as a 50 basis point cut. So cutting rates by 50 basis points. Look how much that black line has moved higher. And that's for open interest calls that they're going to cut 50 basis points. So a pretty big bet is being made that the Fed is going to begin to cut rates, either a quarter point or as much as 50 basis points. And as I said, if they don't make that cut, if they once again say, well, we're just going to keep waiting to see what the data shows us, which is what I think they should do, then I think that would cause some volatility for the markets, take the markets down a little bit on the day of the meeting. One of the reasons why, as I said, I think that the Fed probably could make a case for not cutting is our next chart, which shows the unemployment rate in the United States at 4.2%. Unemployment rate has definitely gone up over the last little while from about 3.5% in 2023, as you can see, to 4.2%. But I think everybody would probably agree that the U.S. is pretty much at full employment. Many states, you're even hard-pressed to find workers to fill the jobs that President Trump wants to fill if they bring back or when they bring back manufacturing to the U.S. So with employment so strong and inflation starting to tick higher, as we're going to see. I have a few charts later on in the show. I just don't see why all of a sudden roughly a 2.5%, 3% inflation rate and a 4% unemployment rate, all of a sudden that means the Fed should be cutting rates. When those numbers existed, 6, 12 months ago, we said inflation wasn't low enough and they would not consider cutting rates. But now all of a sudden, these numbers seem to be low enough for the Fed to cut. So we're going to have to keep an eye on what Jerome Powell says at his speech at Jackson Hole. It's definitely going to be a market mover. Our second point that I think individual investors should focus on over the next 5 to 10 business days, as we've said, are corporate earnings. Corporate earnings, for the most part, we've seen the majority of them, but the big one, the granddaddy of them all, the biggest company in the world today, the company that has moved more so than really any other stock over the last, let's call it, few years. It's not the biggest market mover this year or biggest gainer this year, but it has been one of the biggest gainers over the last few years, has been NVIDIA. And they're going to report earnings next week, midweek. And we can pull up a chart of NVIDIA that we have. And you can see it's been a fantastic chart. There have been some times where people have sold off. And one of those times was earlier in the year and back in March and April. You see the chart coming down. But really, since, let's call it, end of April, this stock has been on a tear, pretty much a straight line from the bottom left to the top right. We're hearing a bit of rumblings in the last 24, 48 hours of some investors saying that the tech space all of a sudden looks overvalued. And we've seen NVIDIA come off a little bit with some of the other chips companies like AMD and Micron and some of the others. But overall, NVIDIA, a big market mover, and it's a name that we're all going to be watching for those results in about a week's time. Some of the other companies that one of them just reported recently, Home Depot. We have a chart on that. Home Depot is one of those stocks that many people believe would benefit tremendously from a lowering of interest rates, because that would spur on, or I guess cause some activity or increase the activity in the housing sector. And where does Home Depot live? In the housing area. People trying to renovate their, people trying to improve their homes, home improvement. That's where Home Depot lives. And even though they had mixed results, they basically said that they're keeping their forecast for a remainder of year. And I think they were rewarded for that. And the stock on that day, as you can see, went up 3%. And the now trades just over $400 a share, down a little bit today for investors. Some of the other names, as I mentioned, that are going to be reporting next week, Canadian bank stocks. Our first chart shows TD Bank stock, trading now over $100 a share. What a run it's been on since April. I remember the days when a lot of people were concerned about TD Bank, about their money laundering situation, their issues down in the US that TD had. The stock fell to as low as maybe $75, $76, but has come roaring back to over $100 a share once again. And we're going to hear from these banks. What are they going to say about business, about lending in this market? I think we're going to hear some difficult talk, I think, in the lending market. We'll want to hear about TD's business in the US. We're going to want to hear about net interest margin, how much TD is setting aside for bad debt or debt that could possibly be defaulted on, wealth management fees, what's going on at the banks, what is the country look like? Because as we say always, Canadian banks are the bloodline of the Canadian economy. Our next chart, CIBC Bank. You can pull it up there. You can see the chart looks very similar to TD. And we have the third chart, the biggest bank in Canada, which is Royal Bank. Royal Bank stock also doing extremely well and has done well even in the month of August. So there doesn't seem to be any slowdown in this stock, getting closer and closer to $200 a share. And this stock, or this bank stock, has just powered through everything. For any of you that have owned shares in Royal Bank over the last couple of years, you've been quite pleased. And it'll be interesting to see what they say. It is interesting to hear what they say, I should say, about Canadian lending, Canadian business. Royal Bank is such a large bank, one of the largest banks in the world, that they obviously have business all throughout the United States and other places. So Royal Bank, definitely something that individual investors need to focus on. So overall, even though we've been through earnings season, still a number of investments, corporations got to report earnings that are going to make a big difference in portfolios. Being Canadian, a lot of Canadians own Canadian bank stocks. And if you've been invested outside of Canada, chances are you've been invested in the tech space and NVIDIA. Whether you own the shares directly or you own other shares in the tech space, all of that will be affected by what NVIDIA says next week. Our third point that I want to focus on for individual investors to consider before they make their investment decisions is this idea of buying good value, and buying good value at good prices wins out in all markets. And as I said off the top of the show, I wanted to talk about this because I've been getting some questions from individual investors, as I do always. And they're saying, Allan, if you think there's some volatility coming in the months of August and September, why would you be a buyer into this market? Let's wait a little bit and maybe buy afterward. And yes, I understand that way of thinking, but we just don't know if August and September are going to be bad months this year. August hasn't been too bad so far. I know now we're getting into the latter half of August, which usually is where the volatility starts. And as we know, September is notoriously a negative month for the market, slightly negative. We're not talking big negative numbers. So why not wait? Well, the first answer is because we just don't know if the pattern of volatility is going to hold. And our first chart will actually show us this. We see a chart here which shows seasonal returns by month. And yes, it's tough to read some of these numbers, but I think the main idea is green means growth and pink means negative. And if you look at the top, right along the top are the months of the year, and the first row is average. And you can see everything is in green pretty much except for 2 pink months, which are August and September. But if you go down the columns, not every August is negative. If you look at 2024 was positive, 21 was positive, 20 was positive, 2018 was positive. Even in September 2024 last year was positive, going to 2019, 18, and 17. 3 positive years in a row. So it doesn't mean just because on average something happens that it's going to happen every year. So understanding that, oh, let's hold off. Well, you might miss out on some good gains. And if you look at the types of investments to buy, if you consider buying good quality at a reasonable price, and we call that GARP investing, and GARP stands GARP, growth at a reasonable price, you will see that owning good quality investments at reasonable prices are able to withstand a lot of volatility, or let's call it a negative environment for stocks. They can power through. They may fall, but not fall as much, and they tend to rebound a lot quicker as opposed to owning names or stock that is a high flyer, that is very highly valued or highly priced. And those are the ones that tend to fall the most and the quickest. They start with those names, the market sells those names off first, and then moves to the better value names later on. And so the downside risk, how much you can lose, let's say, in putting in layman's terms, tends to be less with cheaper names that you own, good quality names on the cheap, than the high flyers that you buy at high prices. Our first chart that we have for this, a second chart that we have for this segment is Invesco QQQ. And what this is the tech index, pretty much, the NASDAQ. And you can see here, yes, we had a difficult time in March and April earlier this year. But if you look at the bottom part of this chart, it's a longer term chart. And you can see how these types of negative, let's call it negative moments or points in time that are negative, over the long term, you really don't see an awful lot of that. It kind of gets, lost in the market, meaning over time, this market goes higher. Good quality names go higher. And what are the best quality names today? Yes, I believe the best quality names are in tech. These are the biggest names in the world. These names seem to move at times less than other names in other sectors. If you take, for example, Apple during the pandemic, and you were to compare that stock of Apple, for example, at that time, the biggest company in the world, compare that to bank stocks or other stocks, you would have found that Apple actually fell less during COVID times than bank stocks did, and other stocks in other sectors did. So tech has been able to withstand a lot of the volatility that you get from a seasonal perspective or from other means. So Invesco QQQ just tells us that you own some good quality tech names, you own them at good prices, they're going to power through. Some of the actual individual names that I wanted to show you today, we've talked about these names in the past. First one, Alphabet or Google. We have a stock about, there it is. You can see here, yes, there have been ups and downs along the way, but pretty much if you look at the start of the year, forget about April, which was the bottom of the market for this year, but if you look at the start of the year, and you draw a straight line, you're going from the bottom left to the top right. Google trades at about 20 times forward earnings. Compare that to a name like NVIDIA, which is at 40 times, AMD 40 times. A lot of other tech names trading much higher, which I'll get to in a moment. So a name like Google, I think, is a fantastic name to own, even during perhaps a volatile month like September. Our next stock here is a name that we all talked about many times, Meta Platforms, or formerly Facebook. Once again, Meta able to power through most difficult times. They are a stock that people definitely look at to buy on the dip. And if we do get a bit of a dip in the last couple of weeks of August and into September, I think individual investors, if you can handle the risk that a name like Meta brings, it could be a name that investors buy on the dip. Now, if you were to contrast names like Meta and Google with a name like Palantir, Palantir Technologies, a name that some of you may be familiar with. Palantir basically makes software to analyze lots and lots of data. So who uses Palantir probably the most? Government. Government uses Palantir software to analyze data on immigration, analyze data on many different things. Palantir has become very important to the United States government. And because of that, and because of their AI that they've incorporated into their business, Palantir has been, as we'll get to shortly, the best performer this year, even with the recent pullback. But if you look at a name like Palantir, let's pull up a chart of Palantir. You can see that if you look at the far right-hand side, that's a name that has been selling off lately. I think they've had 8 or 9 days in a row where they've come down. A name like Palantir, 150 times earnings, just a crazy number. Buying and owning that stock, you got to understand you're in for a lot of ups and downs. You've had a lot of ups recently. Perhaps you're going to see some downs. We're already seeing it already in the month of August, but perhaps we could see some more downward pricing in the next 4 weeks. So a name like Palantir, again, good name, good company, but just too high price. So those are the names that tend to fall quickest and the earliest. And our next chart, we can pull up IBM. Why did I pull up IBM? IBM tends to be one of those blue chip names. We used to call IBM a blue chip company. Never really moved an awful lot, went up gradually over time. Well, I can tell you that IBM, I would say there's probably no such thing as blue chip anymore, but IBM has been on a tear since April up until about, let's say, beginning of August, maybe towards middle of July. IBM has had a fantastic run. The stock has moved all the way up from like a 12, 13 PE or price to earnings ratio to over 20. And so you say to yourself, okay, do you want to own IBM in a market where you could have some volatility at this current price? I'm going to say probably not, because I think IBM now is overpriced, a little bit expensive. And we're seeing IBM volatility right in front of us play out. You're seeing it on this chart. It has come down quite a bit already in the latter half of July and the month of August. And so once again, you want to buy good quality names, but you want to buy them at good prices. So it's kind of like a two-prong attack. You want to own good names. You want to own them at good prices, because when markets turn down, it's the good quality, and it is the names that you bought at good pricing that will hold that pricing best. They have, I guess, the least or the less margin for loss. Whereas if you buy something that is highly priced, the opportunity to see a pullback is much greater. So the last point I wanted to make for individuals to consider before you make your investment decisions is to own good quality names. Go out and buy those good quality names, but buy them at good prices. And I think if you do that, you can continue to buy stock even during volatile times, such as the last few weeks of August and into the month of September. So how long can markets keep climbing? This is probably the number one question I get. I wonder if I put that question out on Chat GPT or Grok or any of the AI platforms. The number one question investors are asking, perhaps it's how long and how high can these markets go before we see a pullback? Well, notoriously, as we've said on our show many times, you have a good July, which happens more often than not. Coming into August, you get a bit of a sell-off at the end, and that sell-off continues in September to see a reversal in October, and then October, November, December, the 3 best months of the year for investing, and into January, which tends to be not a bad month either. So that's what the calendar tells us. But I guess the answer to this question is, what made the markets go up to begin with? I think a couple of years ago, coming out of 2022, market was struggling. 2023, a lot of people were calling for a recession. We saw interest rates going up tremendously, 11 times in a very short period of time. What was going to be the catalyst to take things higher? Well, definitely was the tech space, big cap tech, and artificial intelligence. Chat GPT broke onto the scene shortly after, and we've never looked back. All we talk about now is artificial intelligence, AI, AI, AI. And so to know how high markets can climb, we got to figure out how long can this AI boom last. Well, let's take a look at our chart that we have first, artificial intelligence market. And there you have it. Look how much the market not only has grown already, but is projected to grow over, I guess, going all the way till 2030. And who's leading the charge? North America. North America is the dark color there. Right behind it, closely behind it, is Europe. And actually, I apologize. It looks like Asia actually is the bigger piece there. So Asia is probably growing faster, it seems, or at least predicted to grow faster than North America and Europe. So interesting that that chart would show that. But it is our next chart will show that when you talk about the best AI investment ideas, our next chart shows this. Who do you have? Well, a resounding group of people that took this poll. It was a Seeking Alpha poll of readers. What's the best AI stock? NVIDIA. NVIDIA is the best AI stock to own, followed by Microsoft, Google, Meta, and AMD has come into the top 5. So even though Asia is predicted to boom with respect to AI, it seems like, well, the biggest and the best names to own and the most popular names are all big cap tech names in the United States. Our next chart actually shows this, how much of an outperformance big cap tech is doing, or how well they're performing versus small cap tech, or even some of the medium-sized companies. And you can see here, it is outperforming by quite a bit. The medium size is the black, the smaller tech names is the yellow. But look at the, I guess you would call it pink or red. It is outperforming by quite a bit. And those are your Microsofts, your Amazons, your Googles, the Metas of the world. It is unbelievable how much big cap tech is outperformed, even small cap tech, which is unusual. I've seen stats say that big cap tech up about 16%, whereas small cap tech is basically flatlining, as you can see here. So it's outperforming by quite a bit. And so getting back to our original question, how long can this go? Well, if the last 48 hours is any indication, the market will go higher as long as it goes higher. The sentiment will still be bullish until it's not. And it may sound really silly to say, but if you look at the last, let's call it 1.5 trading days, all of a sudden we've seen a sell-off in the NASDAQ and a sell in tech stocks. We've seen NVIDIA come down by actually a good margin. AMD has fallen to obviously the 2 biggest chip producers. Taiwan Semi has fallen. We've seen a pullback in general in technology, even Meta, Microsoft. So why is that happening? Because nobody has an answer. It just seems like all of a sudden, what people were saying prior, which is, well, maybe there's an overvaluation in technology and everybody ignored it. All of a sudden, some people are not ignoring it any longer. They're talking about valuation and how things are fully valued or even overvalued. S&P 500 trading at around 22 times looking forward, and that tends to be overvaluated. So how long can this market rally? My answer will be as long as individual investors are excited to own these good quality names. But make no mistake about it, you can still make good money owning good quality names, even if a market or an index is starting to pull off a little bit, as we've seen in the last 36 hours or so with the NASDAQ and S&P. So am I concerned? Not really, but I think you still got to continue to look for good quality names, not worry as much as, okay, when's the next fall happening with respect to the markets, but just continue to look for good quality names, as I said in the previous segment, and let the market take care of itself. And I think you will not be disappointed going forward. Snapshots of the markets in 2025. So this is where I came across, it was an interesting story. I came across a couple of interesting facts about the markets for this year. And I thought, hey, why not bring them to all of you? Some things that you may understand or some things you may know already, I should say, and some things you'd be surprised to learn, and some interesting facts. And I thought I'd bring maybe a handful for the show today. First, interesting fact that I came across. If I were to ask all of you, what is the best performing index in North America in 2025? What would the answer be? Well, it would be the TSX, strangely enough. And there you have it. This was actually taken a couple of days ago, so numbers may have changed a little bit. The S&P 500 has probably pulled back a little bit, so has the NASDAQ for sure and TSX. But overall, the TSX has been the best performing index in North America, which if you go back over the last decade, you'd be hard pressed to find a year where the TSX is outperforming the NASDAQ or the S&P 500. It's been a great run for the TSX, but even a better run for the US indices. If I were to ask all of you watching today, what has been the best performing stock exchange around the world? I would bet most of you wouldn't know that answer, because the answer is the Athens Stock Exchange, and it is the Greek Stock Exchange. Greece has been a fantastic place to own stocks. Go figure. One of the smallest countries around, the exporting of different things such as olive oil, energy a little bit as well. But Greece has turned around their economy. I remember back in 2011 when Greeks couldn't even figure out if they could pay off their debt, if they would make their debt payments. And that unfortunately took down much of the world's markets. But here you have Greece. And now Greece is up about 55% year to date. 55%. An unbelievable run. Recently, I was speaking to some that are living in Greece. And when I told them that their exchange and their markets have been the best or one of the best in the world, they couldn't even believe it. They were just something that blew their minds to think that the Greek exchange, the Athens exchange, was doing as well as it has. Coming back to home, if I were to ask all of you, how much the Mag 7, those big cap tech 7 stocks, make up of the entire S&P 500, what would you say? Would you say greater than 30%, less than 30%? Well, the answer is over 34%. So the Mag 7, just 7 stocks, versus the other 493, make up over 34% of the market capitalization of the whole S&P 500. Unbelievable. The blue actually shows the net income. So these big cap or these big 7 names make up 34% of the S&P 500, but only about 26.5% of the income. And one of the reasons for that actually is Nvidia. Nvidia is so large that its income is actually finding it difficult to keep up with its market capitalization. So Nvidia actually is a bit of a negative there. You would hope that 34% of the market, you're also making up 34% of the income. But because of names like NVIDIA that are just too large and very hard to keep up with income, that is taking down the income number. But a name like Alphabet or Google actually goes the other way. It doesn't make up as much, but the income has been really, really good. So another interesting stat there. How much does NVIDIA make up of the S&P 500 on its own? Well, let's show a chart. We have it there. This chart is actually a little bit outdated. It shows about a 7.5% weighting. It actually has gone past 8% of the S&P 500 on its own. S&P 500. NVIDIA makes up over 8% of the S&P, surpassing what Apple was, which was over 7% in 2023, I believe. Apple made up over 7%, and these numbers are a little bit changed now. Apple is about 6%, and NVIDIA now is just gone through the ceiling and up 7.5%. Best performing stock, I've already mentioned it earlier in the show, Palantir. Palantir has been the best performing stock. Yes, on the right-hand side of this chart, you can see a bit of a tail off. But prior to that tail off, Palantir has just been lights out, just unbelievable. The best performer on the S&P 500, even with the decline that we've seen in the last few days. Palantir continues to perform at a fantastic return. And if you're an investor that has been in Palantir and have had the stomach to withstand the ups and downs, the 150 PEs and all of that, Palantir is still, even with the recent decline, has made you a lot of money. So wanted to throw in some interesting stats for all of you statisticians out there that was wondering what's the best stock exchange in the world today? What's the best stock performer? You know, how much does the Mag 7 make? What has been the best index in North America? We can all hang our hats on the TSX because, we're all, Canadian here and that are putting on this show. So very proud. I'm very proud to say the TSX has been a very good performer. So a lot of interesting stats. Will that play a factor in how you build your portfolio? Absolutely. And definitely you should keep some of these statistics in mind before you make your investment decisions going forward. So our market's ignoring the inflation. Well, it just seems like right now in the United States, not so much in Canada because our inflation rate is 1.7% and our target is 2%. So we're well below the target. But in the US, we're starting to see inflation get closer to the 3% mark. But at the same time, we're starting to see a weakness in jobs growth. We can put up a chart to show this monthly job changes in the United States, and it'll clearly show. Take a look at the last few months. July, 73,000 jobs gained or created. But in the 2 months prior, and as we showed this on our last show, 258,000 jobs were taken off, or there was a revision to those 2 months, the months of June and May. And that was, in my opinion, what started to spur on this worry about jobs. And what has really gotten some of the Fed officials to pay attention and take notice of where things are at with respect to the U.S. economy. And some of the Fed officials are saying we're seeing a slowdown, and we think that the Fed needs to cut rates to get in front of this and not, wait too long. Because if the U.S. lets things get out of hand, if they start to see negative jobs, that might be too late to cut rates. And I think the Federal Reserve would like to be a lot more proactive than reactive with respect to this. But our next chart will show you that, yes, they may have a jobs slowing down issue, at least a mild one, even though 4.2% unemployment rate in the US, but they're starting to see inflation rise. Our next chart shows PCE, a rise in PCE, 2.8, 2.6%. You couple that with what we've seen with CPI and PPI. Our next chart shows US CPI coming in at core above 3% now, 3.1% versus 2.7%. Couple that with PPI, which we don't have here, which also is getting closer in and around that 3% mark. You talk about import prices coming into the United States, up 0.4% last reading. Again, a number we have not seen in a long time. you're starting to see a lot of pressure on prices. And so what does the Fed do? What does the United States do? Do they focus more on slowing economy? Although I'm sure President Trump would say the economy is definitely not slowing. Or do you focus on this, what looks like a rise in prices? Will this just be a temporary rise in prices? Will it be a temporary pullback in jobs? That is the question that the Fed has to deal with. But it just seems like right now, Fed officials are starting to focus more on the jobs and less on the inflation. I hope it is the right thing to do going forward. We're going to have to pay a lot of attention of the data that will come out before the September 17th meeting of the Fed. And I think that will dictate what the Fed does, whether they cut a quarter point. I don't think they will go as high as a 50 basis point cut, but we're just going to have to see what the data tells us. Quick hits. These are three things that have been in the news over the last little while. Wanted to comment on because they definitely have caught my eye. First one, why Trump might have to cut tariffs. Well, why will he have to cut tariffs? I don't think he's going to. I think he's too proud to do that. But why he may have to cut tariffs, many people are saying, is because we're just not seeing tariffs doing what the president wants to do. We're not seeing the positive numbers in the data, the positive numbers with respect to manufacturing. We're just not seeing it as yet. Maybe the president would say it's going to take a little while, and perhaps the president may not even be in office by the time his vision comes to fruition. But for now, maybe they may want to pull back a little bit on those tariffs. Intel getting $2 billion investment from SoftBank. We're hearing that not only as the U.S. government, but also SoftBank investors investing a lot of money into Intel. The government is wanting to have some winners in the United States, have some chip production in the United States, not leave it all in Taiwan. Our third quick hit, analysts downplay Altman AI bubble worries. Sam Altman, who is the leader of ChatGPT, OpenAI, the parent company, has been saying perhaps we are in a AI bubble. And well, I think he, in my opinion, probably didn't mean it that way, but a lot of people have taken his words to mean that. So let's go to our first chart here, which is one on U.S. manufacturing. And this has to do with why we may think that President Trump may cut back some of his tariffs. Right now, the average tariff rate in the U.S. on any goods coming into the country is somewhere around 15 to 18%. About a year and a half ago, it was maybe 2%. So prices have definitely gone higher. And we can see from this chart, it hasn't really panned out with respect to manufacturing employment coming down, capacity utilization, which is how businesses are using their capacity, their manufacturing plants. That's come down, and production from these plants have come down as well. Businesses are seemingly on hold right now just because of the confusion, the higher prices, the higher costs. Things are on hold. Businesses are not expanding as much as they would like to, and many believe it's because of the tariffs. So maybe President Trump does something about that. Our second quick hit is about Intel. Intel receiving an injection of money from government, from SoftBank, and I think many, especially the government, are hoping that a name like Intel can can claim or reclaim its once glory. Once upon a time, we have a chart on Intel we can put up. Intel used to be one of the best performing tech stocks. The 8,000-pound gorilla in the room, it was the biggest and the best when you talked about chips for anything. It was Intel, and boy, have the mighty have fallen. You can see here with the chart how low Intel has come. Intel has actually popped up a little bit from about $20, $22 to over $25 recently because of this injection of money from companies like SoftBank and the U.S. government taking a bit of a stake, an equity stake in Intel. But make no mistake, I still believe Intel is quite a ways behind names like NVIDIA and AMD. And our last quick hit, this is this comment up from Sam Altman, the head of OpenAI, the parent of ChatGPT. He talked about how there is possibly a bubble forming. I'm not so sure. We have a chart on AI in the next gen software ETF. You can see how well it's done, so I can understand why he talks about this bubble. But to me, bubbles would imply that companies are just not making money, that they're extremely, extremely overvalued. And I'm just not seeing that. Any of these big cap tech names that have to do or deal with AI or use AI, they're all making a lot of money. They're doing extremely well. And many of these companies not only are in the business of AI or using AI, but they're doing a lot of other things, such as an Amazon or a Microsoft that has hands in many types of businesses around the world and many different sectors, whether it's grocery like Amazon, pharma like Amazon, whether it's gaming like Microsoft, or social media. Microsoft owns LinkedIn, for example. So I think these businesses are too diversified, in my opinion, make too much money to be considered an AI bubble. Now, the part of the show where I take a question from the audience. And again, as many, we get a lot of questions throughout the 2-week period. I thought I would talk about this one because we really didn't talk about gold during this show. But this year, 15 of the top 20 performing TSX stocks are Canadian gold producers. With the geopolitical uncertainty and global market volatility that we've seen recently, do you recommend investing in gold? A great question. And first thing I'll say is gold is definitely not for the faint of heart. I've seen gold prices fall $100 an ounce, $50 an ounce, go up $100 an ounce. I believe in, I was actually, let me take a step back for a second. I was on BNN a few, maybe a month or so, a couple of months now, and we had on this person talking about gold, and it was their belief that they would see gold fall as much as $1,000 an ounce. And I said at that time that I'm not saying gold is going to do that, but the reasons for it falling back or pulling back, strength in the US economy, strength in the US dollar, I do believe in. And I do therefore believe that gold prices can fall based on that. Gold is a hedge against the US dollar, US economy. And if you see a strong US economy and US dollar, that tends to bode not so well for gold and gold prices. So would I be surprised to see gold pull back to 32, 31, maybe even 3,000 an ounce? Absolutely not. There is definitely a lot of volatility in the world still till this day. There is inflation fears, which also helps gold. But make no mistake, I still believe the United States is the most dominating economy in the world, $30 trillion economy. Right now, they have a few bumps in the road because of the recent trade negotiations and trade agreements that have been put in place. But going forward, I think you could see the US dollar gain strength. It's already gaining strength versus the Canadian dollar over the last, let's call it, couple of weeks. And I think you could continue to see it gain strength against all the other major currencies around the world. And therefore, I wouldn't be so quick to buy gold stocks or gold in general. So with that, I want to say thanks to everybody for joining us on our show today, taking the time out of your busy day. As I always say at the top of the show, I want to say that hopefully all of you can tune in on our next show 2 weeks from today, Wednesday at 12 noon. We will have a special guest. Ian Lee, Associate Professor, Management of Sprott School of Business, will be our guest. He will be talking about, with me, we will be talking about the Canadian economy and what's going on trade, his thoughts on trade and how this is affecting our Canadian economy. I'm sure we'll get into what the Premier has been requesting, which is a cut in taxes, cut in interest rates. We'll get into all that and bring it to you on our show. So that's 2 weeks from today, Wednesday, 12 noon, across all social media platforms. And until then, as always, I want to wish everybody a happy investing.